Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. We're one day away from the next USDA report, and as of late, looks like corn has been moving up pretty nicely. We did get a minor correction over the last couple of days, followed by a nice bounce yesterday, but looks like the market has potentially topped near resistance near 365. Depending on how the market moves today, we look for the market to potentially continue sideways for the balance of the day. Tomorrow's USDA report release is going to be telltale for us as to whether or not this market then looks to move down. And projection-wise, we're looking for the market to perhaps go down for about a week or two before finding a reasonable low, and from there potentially making a reasonable bounce. We have resistance at the 270-degree mark at 366, coupled with our February 8th time factor, giving us time and price coming together. And in the event that the market does reach this level today or tomorrow, we think that reasonable resistance could in fact hit here. And then we'd be looking for potential support to come in somewhere in the neighborhood of 353 for this March contract going into the end of the month. The May contract is obviously giving us a very similar pattern, where yesterday's low came in right at the 365 mark at support along our natural trend line. The market then reversed back up and gave us a very nice move to the upside, and once again we can see resistance overhead at the next green horizontal line near 372, 373. In the event of a bearish reaction to the report tomorrow, we'd be looking for potential support to come in somewhere near 360, and we can see that evidence in the next chart as well. That 360 mark comes in very closely to our factor here that we see with a natural trend line that came in our measurement against these two angles in their intersection point. And we took a Fibonacci range of these levels, and where we found very good support came in yesterday at that 365 at the 50% level. And the key support that we saw coming in was at 363 3/4, which is the Fibonacci 61.8%. So depending on how the market moves tomorrow, if it continues to edge higher into the USDA report, a break of that 363 3/4 suggests that the market coming in to test 360 is a good number. And upon finding support perhaps near that 360 number, this is where we could look for the May contract to turn back up again. If it breaks below the 360 number, then we would look for a retest of previous lows, where the market could very well come in and test 351 before turning back up again. But for now, given the way in which the market has been trading, we're looking at that 360 number as a key factor for potential support. On January 12th, beans made a significant low coming in at 944.5. From there, the market traded up 11 trading days up until a high on January 30th, and then we got a 5-day correction on the way back down, where the market made a low on February 6th. We got a nice bounce yesterday off of that low, and we can also see where very good resistance came in at the two levels that we spoke of before. First of all, the $10 mark was very hard for this market, and we can see where several sellers are perhaps lined up and pushed the market back down in the name of some profit taking, and the market dropped very precipitously, just over 50% of the previous advance. After finding support against our 2x1 angle, the market has since bounced up, and we now find a bit of resistance at the Fibonacci 61.8 at 995.5. This is going to be a key level for this market going into the USDA report tomorrow, and as to whether or not the market can break above this number. Depending on the side upon which this market breaks this week, whether it breaks the previous low coming in at about 965 or can get back above the 995 number, will be telltale as to the direction upon which this market can go. For now, part of what we're looking for is the response to Thursday's report. We anticipate that continued strength overhead is probably what we're looking for, as the market simply chops in advance of the USDA report tomorrow. We shared previously where this range of $10 to 1,003 was perhaps going to be very good resistance, and that's exactly what we saw occur here for the market. And in addition to that, we can see where volatility-based resistance overhead was very good resistance as well. Here we can see where our sinusoidal wave came in and gave us good resistance on the day today. And again, the same levels that we spoke of before are going to be very key with regard to the direction in which this market can go. In the event of a break tomorrow, we'd like to see 968 hold up for this market. And as long as about 968 and perhaps the point of control number at 959, as long as somewhere in that neighborhood holds in the event of a drop in response to the USDA report, we still like the prospect of higher prices for beans. Given that we only have about 3 weeks left before the March contract hits first notice, we'd be looking for that follow through in the July contract. Here we can see where the 1028 number and the 1015 half number were very good levels for this contract as the market made their first attempts at those levels. And upon reaching those levels, we can see where resistance came in very good and the market had since turned down. We also found where support came in very well near the 991, 992 number. And from here, we anticipate again just simply waiting for the response from the USDA report. Similar to our resistance levels from the March contract, we can see where 1012 half to 1015 came in as very good resistance, with the market coming in conjunction with volatility-based resistance overhead. So once again, what we're looking at is this number here, 1015, is going to be a very key number for the July contract if it's to rise higher. And if the market does drop below, we'd like to see support come in somewhere in the neighborhood of 980 to 93 at a minimum. The price action in wheat futures continues to be very true to form. If we look at the initial impulse move that the market gave us, we can see the distance of this move here. And if we were to take a mirror move of that distance and take a one-to-one correspondence, that takes us up to just above the 437, 438 number. If we go up a little bit higher than that at about 127%, which is a Fibonacci extension area, that puts us right at the 270-degree mark at 445. This, in essence, was a very key level for us, and the market's ability to close above this 445 number told us that the market wanted to touch at a minimum somewhere in the neighborhood of 455 possibly. And in doing so, the market now is back at that area, and we're looking at a minimum price objective for the actual March wheat contract to hit our 180-degree mark at 466.25. Upon getting here, the market could very well get up to about 482, but for now, our minimum price objective continues to sit at 466.25, but we do believe that continued strength going into the forward contracts is possible, given the nature in which this market has been moving up very nicely in accordance to our market cycles. One of the obstacles that this market did face was an overlap of volatility-based support and volatility-based resistance. Now that the market has come in, we can see very clearly that that support level near 438 that we discussed before was a very good area for this market to find support. And upon bouncing up from there, we're now reaching the top end of volatility-based resistance. And once again, that 466.25 number looks like it's probable for this market to reach overhead. The next important time factor we'd be looking for in this contract lands on March 8th. Given that this timeline is beyond the first notice date, once again, we'd be looking to the forward contracts for additional data. We will again close out our day taking a look at the US dollar. We discussed before where the market came in, and the tangent line to our arc swing gave us a January 30th timeline, which was very close to the low that we now see that occurred for the US dollar index. We had a very key low coming in at 89, which was our price target for the market. It came in, hit that price objective, and we can see now a very nice correction occurring on the way up after having had both time and price come together very nicely for the US dollar. We're looking at potential overhead resistance now coming in near the $91 mark. And with the ability of this market to get up maybe a little bit higher, it could still test the $92 mark overhead. We'll continue to monitor the way in which this market trades, but as we look at the larger time frame perspective on the weekly chart, we can see how this smaller daily time frame chart really correlates very well with the larger time frame to give us a good perspective of what may happen with the US dollar. We've discussed previously how the market came in and gave us a very nice 5-wave sequence, coming in and making a wave 5 top. After that occurs, we anticipate an ABC correction to occur, and the market has now given us that, and we have a confirmation at those levels. We had a price objective coming in near 87.75, and the market did reach that price objective, which was about 50% of the downside range measured from the impulse drop. Now we're looking at a potential correction where the market could find resistance maybe near 91 or that $92 mark that we discussed just a moment ago. And upon doing so, if the market returns to weakness and breaks below this 87.25 number, with the potential of getting down to about 82.30, our ABC would then convert to a new downtrend, and the dollar could in fact be in big trouble, where we'd be looking for this to convert to a new downtrend, where this would be the three leg coming in for a new 5-wave sequence to the downside. So this market's ability to hold above 87 is going to be very key for the US dollar, because breaking back below indicates for us that the dollar is prone to some very big weakness. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next time.